We've got some examples of auditor independence impairments, right? Let's see them here. Now, these are just general examples. I have this note here because this will also appear in our government lesson. So these are just general impairing, impairing independence situations. Significant gifts from the auditor to an audit client or vice versa, right? And we've got examples, like I said, if we're just going on a normal networking event and the audit team is meeting up with the client's team at a bar, that's totally fine, right? If it's in the ordinary course of business, you're just getting to know each other. I've done that many times. I've been on the audit team and go out to meet with the client's team, and you just get to know each other because that's important. It's important to have a good, solid business relationship and get to know each other. So you're not just these faceless people sending email. You don't really know who you're talking to. But if there are, and by definition, it's a little subjective here. Significant gifts. What is that? Now there are rules of specifics, right? I mean, but just like materiality in this exam, it's not going to try to mess you up with that. It can be pretty clear. An example might say, oh, yeah, you just went to a normal happy hour or a dinner with the client. Or they might say, oh, the client bought you a $10,000 Rolex, or the client took you out to a very expensive dinner and bought the most expensive bottles of wine. They'll be a little more explicit with that. They won't leave it up to you to determine if it was an outlandish gift. Next, a credit card balance with a bank audit client that exceeds $10,000. You're going to see a lot of rules with these banking clients where if they essentially have control over you, then you're not independent. Because, and now, like in reality, you could be totally fine, but remember, it's independence in fact and appearance. So let's say, you are a CPA, but you're worth, let's say, $10 million. If you've got a credit card balance with your bank client, that's $10,000, that might be peanuts for you. Not peanuts for me, but if you're a multi-million dollar person, this might not be a lot to you, but this is just the rule. So you would have your independence impaired if you, let's say, we're auditing Chase, and on your Chase card you had $10,000 of credit card charges. I don't know what you're buying, but be a little more frugal. Be more frugal there for you. Auditor has a checking account with the bank client that is above the amount insured by the government. And why is that? Because FDIC insurance, right? If the bank just goes kaputs and they go out of business, the government does insure a certain amount of that money, and you'll get that back. However, if you have more money with that client than is insured, it's kind of like they have control over. And if they go down, they go under, you're going to lose that money. So if you're auditing that client, you're going to probably be more inclined to make sure that they stay in business, give them a good opinion. That's going to for sure impair your independence, right? Same with the credit card example. If you have a lot of debt with them, maybe you want to see them go under, right? So you're going to give them an awful opinion. I mean, these are a little bit extreme examples, but you see what I'm getting at here is, they may seem like extreme examples, but crazier things have happened in the real world. When an auditor's close relative works for an audit client during the period under audit in a key position, okay, if I'm auditing Microsoft, but my sibling just kind of works at Best Buy and sells Microsoft products, that's not a key position, right? Or if they're a small-time salesperson for Microsoft. But if I'm auditing Microsoft and my brother is the CFO, yeah, that's a problem. That is definitely a problem. An auditor has a direct interest, material or not, in the audit results of the client. This is like a general catch-all. So, I mean, if I have if I have a bet with someone that the stock price is going to go up or down, that is the direct interest, material or not. So this is kind of like a nice catch-all because guess what? The AICPA is going to be a little stricter with the rules. They don't want you to breach independence in any way. The audit firm has an outstanding lawsuit against the audit client for a material dollar amount for work related to the audit. It's an interesting point because, again, we are a business and there are disagreements in business. So if you as the audit firm, or you particularly as a CPA, the auditor, you have a lawsuit against the audit client because, well, they didn't pay you for your audit fees. And if it's material, that would impair independence. So small disagreements, quarrels with the client, not a big deal. But if you have an outstanding lawsuit against the client for a material dollar amount, that would impair independence. Also, if they owe you money, I probably wouldn't do any more work for them until they pay you money. So I wouldn't foresee myself, wanting to be independent to then continue to audit them, but that's just me. Lastly here, expressed intention by the present management to commence litigation against the audit firm alleging deficiencies in audit work for the client if the claim is probable to be filed. Lots of wordy talk there, but what does this mean? So the present management of the company has expressly said that they are going to sue the audit firm because of deficiencies in the work that they did. They didn't do a good job if the claim is probable to be filed. So, again, just to recap that, if management says, we're going to sue you because you didn't do a good job, and it's probable that they're going to do that, that would impair independence because now you're going to probably not want to give them, you're not going to be objective. You're going to view them as an enemy and be like, hey, yeah, I'm going to give you a bad opinion. That's just the thought process there. So, good examples of independence. I'm trying to have a good time with this. I hope you are as well. Give you nice discussions on this, nice ways to remember it. Memorize these, make sure you are familiar with them. All right, these ones would not impair independence. Now, these could be multiple choice questions, these could be sims, just like the slide prior. What would not impair independence? Well, insignificant gifts from an auditor to an audit client, or vice versa. You'll see a lot of these are just the inverses of what we saw. So just, hey, I bought you dinner, or here's a working lunch, right? We buy it for the client, or they buy it for us. Credit card balance with the bank audit client that's below $10,000, right? Just the opposite of what we saw. Government, the auditor has a checking account with an amount that's below the amount insured by the government. We see here, again, just drilling this down. I want you to memorize these and have these so ingrained in your mind that you never forget them. Well, you can forget it after you pass the exam, but not until then. When you have a close relative in a non-key position, if I'm auditing a massive food grocery store and I have a kid who works as a cashier there, not a big deal. When an auditor receives an unsolicited financial interest in an audit client through a situation such as an inheritance. Okay, interesting situation, right? You are an auditor, you're auditing, let's say, McDonald's, and then someone in your family passes away and leaves you a good amount of stock in McDonald's. Well, you were never supposed to buy stock in McDonald's, and if you did have stock in McDonald's when the audit started, you had to have sold it. But this is an interesting situation because you didn't ask for this. It was just left to you. Not a problem. You can do something about it. What are you going to do? You're going to dispose of the financial interest as soon as you can, but no later than 30 days after the auditor had knowledge of and obtained the right to dispose of it. Okay, so a couple points here. First off, practicable is a word. That was something when I was recording another lesson. These are just official terms, but practicable means when you can actually do it. So you have to know that you received it, right? Like if the person dies and the lawyer, person dealing with their inheritance doesn't get to you, you don't know about it. And if you don't know about it, you can't get rid of it. Also, if you don't have the right to get rid of it, well, then you can't do anything about it, right? This is a reasonable rule. It's a reasonable request. It's just you have to know that you received the stock inheritance and you have to be able to get rid of it. So just those points there. No later than 30 days after they had knowledge of and obtained the right to dispose of it, or during the period that the auditor did not have the right to dispose of the financial interest, the auditor did not participate on the ad test engagement team. So basically saying if you didn't have the right to get rid of the stock that was left to you by your relative who passed away, you just go on vacation, right? You're not participating with the audit team, and the direct financial interest is not material to the auditor. If it's one share of stock to McDonald's, to be honest, not too material. I'm not going to skew McDonald's financial statements to benefit my one share of stock. That's not realistic. Next up, a member of the audit team serves on an advisory role for the audit client, which is purely advisory and does not make management decisions for the client. Interesting point because, in a way, an audit team is advisory. If you think about it, you're auditing, let's say, their estimates, and you could give them advice, right? You're not acting on behalf of the client. You're not doing something for them. You're just saying, hey, we recommend you do your estimates this way because this is in conformity with GAAP. That's actually very much encouraged. Now, that is advisory work. Now, if you, as the auditor, the audit team, say that, and then you actually do it for the client, or you start making changes in their financial statements, that's a breach of independence. That would be a problem. But here, simply advising the client on how to be more in conformity with GAAP, that is totally fine and actually encouraged. Next here, the audit firm has an outstanding lawsuit against the audit client for an immaterial dollar amount for work unrelated to the audit. So kind of the other end of what we saw before. You're suing, let's say you're auditing, again, a Bank of America this time, you're auditing them, and you're suing them because they lost your money. Like you had a bank account with them and they lost your money. So unrelated to the audit and immaterial. not a big deal, would not impair independence. Oh boy, oh boy. I do love charts. I love these graphics and charts, just really summarizing up everything we need to know. These are going to be a little bit more broad than the items we saw in the earlier slides. These are the items that are going to impair independence. We talked about these, but here it summarizes it up. We're going to see this in our next lessons because it encompasses items that impair independence per the AICPA, per public company audits, PCAOB, SEC, and the Government Department of Labor right there. Now, the AICPA, this is going to encompass non-issuer engagements, assurance engagements. It also does have bearing over issuer engagements. However, SOX, PCAOB, SEC regulations are going to be just for issuers. Now, you're going to see also that the AICPA and public companies are going to be pretty similar as they have the same items checked off, whereas you're not going to have these same restrictions for the Government Department of Labor. I'll go through these two much more in depth in their respective sections, but for now, let's run through this. These would impair independence, direct financial interest. You're auditing a real estate investment trust and you have a direct financial interest, such as mainly stock, or if they know there's any debt, you buy their bonds, something like that. That would be direct financial interest. A material indirect financial interest, that would be anything like they make up part of a mutual fund you hold, or many other situations. Non-financial institution loan to or from the client, right? Just you shouldn't be engaging the client in business. You are their auditor. Employment at the client of a former employee of the firm, unless the former employee cannot influence the firm and amounts owed to the former employee are immaterial. Really, these other ones are going to basically say, okay, like we can't have people going back and forth between the audit firm and the company. That is going to impair independence because we can't say, oh, we audited 1 year, then the next year we are working for the client. And kind of let's talk about that, right? What's the reason? And you're also going to have these cool off periods where the audit partner needs to rotate around. The point here is, let's say you work for the client and then you go work for the audit firm. Well, that's a problem because then you know the ins and outs of the client and you kind of have seen it from both sides. You know, while the goal here is to conduct an ethical and efficient audit, if you have people jumping from one side to the other, then they could tell each other the secrets, right? If you go from the audit firm to the client, you can tell the client how they determine materiality. And, you know, if the client knows how the audit firm will do that, they could try to hide items. Right? This employee going to the work for the client could know how the audit firm is going to conduct its procedures and then can help the client to do fraudulent activities to hide something from the audit client. So all of these things are the items that the client should not know. So if part of the audit team becomes part of the client, that's a problem. So that's like the general gist of some of these points. Now we're going to see that you have essentially a 1 year cool off period before you can go work in these key positions at a client. So you're auditing someone, you need a 1 year period to just not be involved with either entity, and then you can go work for them. Employment at a client of immediate. So this is the family member or close person in a key position. We saw that one on our previous slides. An individual who participates in the engagement is seeking or discussing potential employment with the client or has been offered employment by the client. That would impair independence unless the individual notifies the firm and is removed from the engagement. You got to make sure that we are very careful with these items here. And lastly, a former employee of the client participates on the engagement team when the engagement covers any period of the individual's employment with the client. That's you auditing your own work. That's a problem. That is not good. You can't audit your own work. Here's an example of these disallowed services. So per the AICPA, how do we interpret this chart? Per the AICPA, you cannot do anything with these check marks or these X's if you are auditing. We can't do bookkeeping for the client because if we did the books for the client and then audited that, we would be auditing our own work. We cannot do financial information system design and implementation. These are all services that would directly affect the financial statements, and then we can't go and audit those financial statements because we've essentially helped build them. Actuarial services help determining those numbers for the financial statements. If we were management or human resources for the client, that's not good. Internal audit, that's very not good. We can't do any of these things for the client if we are the auditor for them. service as a broker, dealer, investment advisor, legal services, expert services, all of these, we can't do these for the client if we want to audit them. If we can't have overdue payment of fees, actual or threatened litigation, we saw that before, contingent fees, anything like that. So contingent fees, that's a problem. We can't have the outcome of our audit and the revenue we get from that audit. Remember, the client's paying us, let's say $10,000 to give them an opinion. They can't pay us and say, hey, if you give us a clean opinion, we'll give you an extra $5,000. That's so illegal. That is such a problem, and you can't do that. Can't have significant gift from the clients. Now, here's where we start to see some differences. There are more strict rules for public companies under SOX, PCAOB, and the SEC. But per the AICPA, you're allowed to do tax services related to confidential or aggressive tax transactions. You're allowed to do tax services. It's different. It's different, and you're allowed to do it for the AICPA, but we see we can't do it for public companies. Lastly, partner compensated for selling services other than audit review and attestation services. Different points to memorize. You'll see these in questions, and you'll know it from this chart. Make sure you're familiar with what you can and cannot do per the AICPA, per the SOX, PCAOB, and SEC, and per the government audits and Department of Labor. One last graphic here, and then we'll get back to some normal looking slides. We've got a nice summary here for items that are required for independence. Audit committee pre-approval for public companies. That's required. That means that the audit committee has to pre-approve you as an auditor. You can't just say, hey, I'm going to be your auditor. And they say, hey, oh, cool, we'll pay you. Nope. For public companies, the audit committee, which is part of the board of directors of the company, needs to pre-approve you, needs to vet you, needs to make sure that you as an auditor are approved and proper and don't have any issues. Lead and concurring partner rotation. This is part of SOX, meaning, and we'll get into that when we get into the public companies and all those rules, Sarbanes-Oxley and everything. You can't be the audit partner for 20 years. You're gonna get too buddy comfortable with the client, and that might start to impair independence. So there are going to be rules that we'll see where you have to rotate every certain amount of years. Other audit partner rotation, same sort of item there. If you're the lead partner or you're just a general partner on the engagement. Lastly, here, reporting to the audit committee or those charged with governance. So this is going to be required. You are going to have to communicate to those who hired you. That's what that really means, right? We're going to tell them, hey, we found these issues in your company. Do something about it. So that's what we're going to see. Just memorizing, being familiar with these. You'll see them in multiple choice questions. Get all those free points.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.